So it's great having you on. So Coert, you want to maybe just first of all introduce yourself to the audience, who you are, your background, etc.
Thank you, Neil. Yes, great to be here. Thanks for the invite. Yes, guys, well, it started a long time ago. Just a little bit of background. In 1996, I developed a system, or discovered a system in which you can separate your assets completely from your liabilities. Because that is the biggest danger of any business, any property portfolio. Well, property is also a business. So when I talk about business, I'm talking about property portfolio, professional property portfolio also. So the biggest danger always is, will be the creditors. So we have to keep the creditors away, because you see problems can happen, like a recession can cause serious damage, and you might be in a situation where for a while you cannot pay your creditors like you should have, and if they are hostile, sometimes creditors will understand, but sometimes they're hostile and they want to take your assets. Right, so with our system, that is impossible. So my background is risk management, and that is the biggest risk of business. And so yes, in 1996, we developed that system to separate the assets legally from liabilities. We can do it in South Africa. We can do it in any country. We do it also for South Africans, mostly South Africans listening to this webinar, I suppose. So we can do it in Mauritius as well. That is our favorite place. Would you like me to go into that now, Neil?
Please, yes. We were talking about the double trust structure. So if you can introduce that to the audience, thanks, Coert.
So as you can see, this what was developed in 1996. Let me explain to you quickly what it means here. You see, the big problem with everybody is that they have all their assets in one entity. Like, for example, most people, most ordinary people, and sometimes even extraordinary people, but most people always have it in their personal names. And what I mean with that, they buy their houses in their personal names, they buy their cars in their personal names, they buy everything in their personal names. They, even when they go into business, the shares of the company will belong to themselves, or in their personal names, or to the spouse or so. And that is the biggest mistake that you can make. So what you should do is you split it all. So what I have here on the screen, as you can see, we have the family trust there on the top. And then it's a trust. When I say family there, then I mean it's a trust. Here, the second below that is then a property entity. Now, I don't want to say trust. Mostly when we do it in South Africa, South African properties, we do it in a trust, but it can also be a company, a property company. And then on the right there, we have the business, any other business, whatever business you are in. The whole idea is that when you have a problem in one of these entities, that it should have no effect on the other entities. So, for example, if your business goes bankrupt because of recession and you cannot sell your products anymore or manufacture it anymore because there's just no demand for it, people don't have money, then it should not destroy you in person, or it should not give the creditors of the business access to your properties. So that firewall that I have there between, those are the firewalls that Annemarie was talking about. That is the wording that we use in the trust and in these entities. And in terms of the trust law, and that is like common trust law anywhere in the world, is that the creditors, or your personal creditors, for example, are not liable for the debt of the business or for the debt of the property portfolio, and vice versa. So your personal creditors cannot go to your properties, your property creditors cannot go to your family, and even take your furniture. It's impossible. And these are the things that are happening to people all the time. And if it is not happening in your lifetime, then you're fortunate. It's good, excellent. But it can happen in your lifetime. But there's one time that it will definitely happen. The creditors will zoom in on everything and destroy it all, and that is on death. And we're all going to die sometime. So that is where the biggest destruction of wealth is happening, is on death, if you do not have these structures in place. Because death cost can wipe out everything. For example, estate duty, death cost, the tax that you have to pay is 25%, that your deceased estate have to pay, is 25% already. Capital gains tax is applicable for your assets to go over to your children, and that is another 16–18%. And executives take a percentage, a big percentage also on the gross value of your estate. So most estates are wiped out. And what I'm saying now, it might sound controversial, But I'll give you the easy evidence of what I'm telling you. Are you controlling the assets of your forefathers? No, very few people do, unless you are part of the rich city royals, the people who are keeping these secrets already for centuries, like the Duke of Westminster that Johannes referred to. The Duke of Westminster, for example, he's controlling the assets of 18 forefathers in a 400-year-old trust structure. Yeah. I did a lot of research there back in 1996 on the Duke of Westminster, and that is where I discovered the holy grail to wealth creation. So that is how we do it. Now, if you want to do it in Mauritius, your family trust, for example, then we can set it up in Mauritius. Your business can be in South Africa, doesn't matter. All these businesses that I have at the bottom, the shares of those businesses will belong to a shared trust, not to the family trust. We have another trust. What I'm showing here is just a basic one. I can actually stop sharing now, and then we can talk. So the whole idea is that we put the risk in different pockets, away from the assets, from the paid up assets. Okay, a property, as long as there's a mortgage on it, it is not an asset, it is a liability. But say after a few years, 20 years, it's paid up, fully paid up, then it becomes an asset. So that trust, although it was a liability trust in the beginning, it becomes eventually an asset trust. But still, we keep it separate from the gold and the cash, which is in the family trust. So yeah, so that is in short, Neale, how we do it. So we can do it in Mauritius, we can do it in South Africa, and oh yes, and the biggest benefit, Johannes just touched on it now, is the fact that we can make it all tax-free.
Fantastic. I think, Coert, it's a great way to set the scene, because, you know, there's a lot of people out there, and it's whether it's in your personal capacity or those who are running businesses, but, you know, those are also getting property, and creditors are after them. And unfortunately, our economy is not in a good state right now. And people are suffering as a result of creditors, and they're being extremely aggressive today. So I think this is such important information for people to, you know, to share. This whole double trust structure thing, you know, how do you initially implement it in your business and property? And then more importantly, how does it work for the protection of assets?
Okay, so as Annemarie said, it's actually very easy to move the assets in. Sometimes we have to pay. The most expensive thing to pay, or expensive asset to move into a trust, will be the property, because the normal transfer duty will be applicable. We do have ways that we can minimize that also by registering a usufruct on a property first and so on. But this is now very technical, so I won't go into that. But with that method, with the usufruct method, and moving a property into a trust, we can save about 75% of the cost on a trust like that. On the transfer duties. But yes, how it protects is, say for example, the creditor, my personal creditor, zoom in on me for something personal, an accident that I caused perhaps, and for injuries and stuff like that. So they sue me for a few million. What happens then is, when they come to me in person and they sue me, and if I will have to go to court, if they want to sequestrate me and I go to court to defend myself, then they have to prove to the court that I have assets. Otherwise, they cannot, the court case cannot proceed. And that'll be very difficult for him, or for that creditor, to prove that, because I have no assets. I have personally, as I said here, I own absolutely nothing. Nothing. It's not even my computer that I'm using here. I have nothing, absolutely nothing. I don't even have a cup. I have a glass of water. It's not even my glass. So you see, I'm the poorest, one of the poorest people in this country. So therefore, a case like that will be thrown out of court. It is literally, that is how it is happening. It cannot proceed without me having any assets. So where are the assets? The assets are in the trust. So this last belongs to a family trust. The computer belongs to a family trust. So the furniture, everything belongs to the family trust. And my personal creditor cannot sue the family trust. Okay. Can a family trust creditors sue the family trust? Yes. If a creditor wants to sue my family trust for something that happened there, for debt and so on, it's not paid, then it can happen. But you see, that is where the little things are coming in with our experiences. We only move debt-free assets into the family trust. The family trust owes nobody anything on this glass. So there are no creditors in a family trust. That is the moral of the story. So there where the creditors are, that is where the risk is. And so they can obviously zoom in. So for example, in a property trust, I have mortgages and the bank is the creditor. If I'm not paying my mortgages, the banks can take that property. So that can happen. But they can still, most of the time, Neale, especially you being in property yourself, you will know that if the banks repossess a property or take a property on auction, they actually, it's very seldom that they can recover the full outstanding mortgage amount. So what normally happens with a normal person is, if there is a shortage after they sold the property on an auction, then they come to you in person and they try to collect it from you. Then that is when they will attach your furniture and stuff like that and sell that also on auctions. Now in our case, they cannot do that. If they cannot raise enough money on an auction, and then they have to call it a day. There's nowhere else that they can go to get that money. So that situation will always obviously make the banks think twice before they do that. They will rather come to us and make an arrangement, which we will gladly do. Give us a 6 months payment holiday. Let's see if this recession can pass and our tenants can come back. And so the banks are willing to talk to us because that is the way to do it. They do it anyways with anybody, but with us especially because they know the trust structures. And some people think because of this that the banks don't like trust or grant bonds to trust. And I think maybe some of your questions today will be about that, because some people might have had experiences going to the banks and with the trust to apply for a bond, but it's because they do it the wrong way. And that is again where we have all the expertise with our bond originators, doing it, raising bonds or getting bonds, mortgages for trust now already for decades. We are doing it already for a long, long time with great success. So yes, that is how we don't have any real risk, because what if we lose anything at the end of the day? Then it will be debt. What a beauty. Because as we make the money in a trust, we just pass it over, in a property trust or wherever, or in a business trust, we just move it over to the family trust. The cash is safe. And in a family trust, we do investments, cash investments like with gold and silver and stuff like that. So you just wait for so if they take all your debt away, you just wait for the recession to pass and then you start again. And you cannot be sequestrated. And that's a big thing, because if you get sequestrated in person, then it will be very difficult to even start again thereafter. But in our case, we are unsequestratable.
Fantastic. I think you've got the appetite of a lot of people out there who haven't already applied this. Coert, thanks for sharing that. Don't you feel like you're being a little bit unpatriotic if you're avoiding paying tax?
Yeah, well, no, I'm a South African.
I think a lot of people will agree with that. But anywhere around the world.
I think anywhere in the world, if you can see how your tax money is working, and then I don't think we will look very hard for avoidance methods. But it's not just about that. It's good business practices that I'm talking about. It is applicable in any country of the world and should never be frowned upon, because it is all within the law. And that is the big thing. We are not creating false structures or companies or do laundering of money or anything like that. So it is all straightforward. It is available to every South African. And the principle that Johannes was talking about, they call it the conduit principle in the law, in a trust law. It is one of the strongest legal tax methods that you can think of. And very few people are aware of it. I think if they're not members of our club, they won't know about it. Some people heard about it, they don't know how to apply it, and if you do it wrong, you can go to jail. So it is not something that you should play with at home, so be very careful with these things. But no, I'm not unpatriotic. And then on the other hand, also always keep in mind the capital that we create, work, we invest in companies, we can invest in factories or wherever. So we create a lot of jobs with our money. So we are not taking the money necessarily out of the country. It is still here where it's working.